Hello, my name is Eddie Tofvik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. For another week, Paris milling wheat has very different patterns, though maybe similar results when compared to Chicago, Kansas City and Minneapolis wheat. Here there has been one dominant pattern, a quite large pattern, that last week took a break on the downside. It is of course the dark blue highlighted late August 2024 to date ascending triangle pattern, currently 235 to 241, very narrow at the top now. This pattern has the requisite combined 5+ touches and made up from a lot of smaller patterns within it, but it can be clearly seen on my daily chart. Last week I laid out targets below for this pattern, and I quote, primary target X would be in the 226 zone, for secondary hard to reach target X1 down in the 194 zone. End of quote. This past week we have reached target X, pushing down below it, as well as the significant purple March 2024 to date uptrend, currently 224. However, the market has been seemingly stopped by the 50% absolute Fibonacci line at 219. This, apart from its obvious significance as a 50% absolute Fibonacci line, has importance because it helped hold up prices, I should say, in November and early December last year, and also eroded the bearish incentive back in August and September as well. This is an interesting battle between the bearish pressure. Will it be enough to see further moves lower, or will target X be enough, and the stoic support below at the 50% absolute Fibonacci line be enough to hold prices and start the formation of a new pattern? To this end, I'd like to amend the further targets below into target X1 being at 205 as a secondary harder to reach target, and target X2, the original X1, target X2 being a tertiary target, an even harder to reach pattern target below. Minneapolis wheat. Last week I said, and I quote, "So a very significant move right from the start of this week with consecutive closes below the bright green lower bull channel line of the late January to date bull channel. What looked last week like the market eyeing the overhead bright red middle time, currently at 663, of the late August to mid-November 2024 bullish shift pitch hook, but that's turned into the market taking fright at this and turning lower." End of quote. Prices this week at the start of the week continued their decline down through the previously mentioned 585 to 610 congestion zone, dating between roughly mid-November to last year to late January this year, with some surprising ease, only finally coming to rest at 578, and the proximate high area dating from June 2019, which I previously marked on the chart. Even to me this was somewhat surprising. The recovery in the latter part of this week was only as far as the previously absent support of the congestion between 585 to 610. Now, in the overall picture, had seemingly relied on the bright red bullish shift pitch hook for the late August to early November 2024 move to hold prices up. We are now below this pattern and broken down far enough for me to start considering retiring it for next time, even though the middle time was acting as a cap as recently as 2 weeks ago. What has been left behind by this move lower, ever since at least early January, is a V-top pattern as part of a larger bump and reversal top pattern. The primary target below for this move lower has already been reached in the 585 zone, as has indeed the secondary hard to reach target at 581. The tertiary, much harder to reach, not target but potential, and it is still a potential, is down in the 549 zone, which is in a zone fairly devoid of support, but does seem a very long stretch to make, being below the August 2024 low, below at 563, and the December 2020 low at 542. It may be that the bearish pressure might be exhausted before then, especially as the angle of the bump and run reversal top is very shallow, and the bump that's not that large. Last week I thought the market had just about reached all its opportunities on the downside. This was presumptuous, as we have seen this week, so I do think there is still opportunity on the downside, possibly, but I once again feel, as I did at the end of last week's commentary, and I quote, we have a lot of congestion between about 610 down to 585, dating from November last year to January this year, and that could erode any further bearish incentives, end of quote. I might be wrong on this as well, but it will be very much depend on the appetite to push down below not only the support at 579, but also down at 563, the support there to determine that. UK London feed week. There continues to be on this daily chart, even now, these many months, only one major significant pattern here, and that is the bright red late May to early July 2024 bearish shift pitch fall. The market has recently reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 180 even. To add to this, the recent narrow mix overhead of literally all the moving averages, though they are now starting to separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, a close together compacted zone and area overhead that, as I've said repeatedly for months now, that is brewing up for a significant move. I was, as I've said 11 weeks ago, and ever since, and I quote, even now still looking for that better pattern to appear. Until that shows up, I'll continue utilizing the bright red bearish pitch fall, end of quote. This leads me to my final 4 points, and 3 of them were something I noted on my recent annual commentary on London feed week. Firstly, I saw there the potential for a very large May 2023 cat's ears pattern. This is a bearish pattern, akin to a double top that's formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date, very large head and shoulders pattern, head and shoulders top pattern. These 2 super long-term patterns are still live, and they both rely on one feature, that is below the market, and that is their common neckline, highlighted in dark blue on my daily chart, which is currently at 167.45. This week prices raced down to this support and were stopped, holding both patterns just above this dark blue pair of necklines. The third feature was a little more longer term. It is the March 2016 to date uptrend, highlighted in purple on my daily chart, currently also 167.45. Now this week, after finessing the trend line to take into account the December 2024 low, we have the market crossing over and reinforcing the dark blue necklines at the same level. We also have the May 2023 low at 168 even, which has added its support, however limited that may be, as had been previously breached to the 2 necklines and the finessed uptrend. Now, there is one major possible criticism of the 2 necklines, and that is they have been previously breached and some would argue broken. However, I have transposed these from my longer term monthly charts, and whilst on a daily or even a weekly chart they may appear breached and broken, on the longer term monthly charts where they really live, they are still somewhat valid, and so I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a very close eye upon. Though I have to say the pair of necklines and the uptrend do look interesting at the moment. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.